All right, the Fed's latest two-day meeting set to wrap up later this afternoon. We'll get a policy announcement at 2 p.m. Eastern from the central bank. And at 2:30, Fed Chair Jay Powell expected to speak to the media about the Fed's latest decision. Joining us now about what to expect both this afternoon and going forward for the Fed is Collin Martin. He's the director and fixed income strategist for the Schwab Center for Financial Research. So, Collin, let's just start with, I guess, what we can maybe look for today. As you note, we don't get, economic projections. We're not going to probably get any material changes to the statement, likely not a tapering announcement, but as always, there'll be language to parse.
Yeah, you nailed it. We're going to be looking for hints of what they will be doing down the road. We're expecting very, very few changes to the statement. That was the case in June. It's likely to be the case for this meeting as well. Maybe we'll get some changes as it relates to kind of the uptick in COVID cases and what that means to their outlook. We won't be getting those updated projections. We got those fireworks in June where we pulled forward their first projection. But I think what we're really going to be focusing on is the press conference and what Powell has to say about tapering. That's where all the questions are right now about what the timing will be, what sort of lag there might be from when they announced it to when they started, and if they're going to make any decisions about how they go about it in terms of the products. Will it just be treasuries? Will it be all the products they invest in, such as mortgages, tips, and your traditional treasury securities as well?
Collin, it's Julie here. As we await that presser, that commentary, 1.25% is where we are on the 10-year. And you said in your notes to us, that yield seems too low. Sure, it seems too low, but that doesn't seem to stop it being there. And it's really defied a lot of predictions that it was going to push higher. Is it going to continue to do that?
It has defied expectations. We don't really think that yields are going to continue to fall from these levels. Like you said, we think 1.25 on a 10-year Treasury yield is just too low given the outlook we're looking at. We're going to get the second quarter GDP report tomorrow, expected to be north of 8%. And even if we look ahead to 2022, consensus expectations are for growth, 4% or higher. And that just seems too low. But like you said, we're still here. We're at 1.25 on the 10-year Treasury yield. That's likely due to the rolling over in inflation expectations, the rolling over in growth expectations, and probably as well as the recent uptick in coronavirus cases and what that might mean for growth down the road. But to your initial answer, we don't think yields are going to fall much further from here. They could be in a trading pattern for a little while until we get more economic data that can lead to them to trend higher by the end of the year, because that's ultimately our call. We think they can rise maybe to the 1.75%, maybe 2% if we get some really strong economic data. But we admit that given the starting point right now, 2% could be a challenge by year end.
Collin, we've been talking all morning long about companies having to raise prices because of inflation. In some cases, those price increases are pretty significant. What's the chance that Chair Powell comes out today and changes his language from transitory to another word? And if he does, what's the market reaction?
I'd say pretty low. We got his comments a few weeks ago in his congressional testimony, and he continued to talk about transitory inflation rates. We still don't have that June PCE report. That's their benchmark for inflation. We're going to get that later this week. So I think it's too early for Powell or really the committee as a whole to change their tune there. But it is something we need to look at in the months to come, because at some point, transitory is no longer transitory. And if we continue to see inflation readings tick higher, they can't really keep singing that tune. So I don't think we'll get that just yet. If he were to mention that it was no longer transitory, that would likely spook the markets a little bit, but we think it's a little too early for that.
And, Collin, we're now, I think, only about 4 weeks out probably from that Jackson Hole conference. Does that seem to you like the right time for the Fed to introduce it? So I guess they intro the potential policy change, and then, of course, 3 weeks later in September, at the September meeting, they, presumably would go ahead and do that. Does that feel like a timeline that makes sense to you?
That's a logical timeline. It's still, open to interpretation. Powell has been very clear about the time it's going to take. He's almost, knocking the markets on the head, saying we are going to do this very patiently. We're going to be very open and transparent about it. So it would be logical if they sort of, made a semi-formal announcement in Jackson Hole where September was the official announcement, where they then gave a timeline about when the tapering will actually begin. So that would be logical, but we'll see how, the market progresses, how the economic data progresses as we get closer to that conference.
All right, Collin Martin, Fixed Income Strategist for the Schwab Center for Financial Research. Collin, thanks for spending some time with us this morning. Appreciate it.